Most traders begin a 10-account challenge with the wrong question. They ask, how fast can I turn this into something big? That question feels ambitious, but it carries a hidden poison. Because the moment speed becomes your focus, judgment leaves the room. Patience disappears. Risk expands. Small mistakes become reckless decisions. And suddenly, what was supposed to be a disciplined exercise becomes gambling dressed in market language. But what if the real question is different? What if the real question is, can I trade 10 with the same discipline I would trade 10,000? That changes everything. Because the market does not care about the size of your account. It responds only to behavior. It rewards clarity, punishes impatience, and exposes weakness with brutal honesty. A careless trader with $10 will become a careless trader with 10,000. A disciplined trader with $10 is building something far more valuable than profit. He is building character under pressure. And character is what survives volatility. Think carefully. Why do most small accounts disappear? Is it because the account was too small? Or because the trader's expectations were too large? A $10 account creates a strange psychological trap. Since the money feels small, discipline feels optional. Stops widen. Entries become impulsive. Position sizing becomes absurd. A trader risks 30%, sometimes 50%, on one idea because losing $10 feels insignificant. That is where the damage begins. Not in the account, in the mind. Because habits do not scale upward, they travel upward. If you train yourself to chase candles on a $10 account, you will chase candles on a $1,000 account. If you train yourself to revenge trade after a loss, more capital will only make revenge more expensive. If you train yourself to overtrade because, it's only a small account, then size will simply magnify your worst tendencies. So the challenge is not financial, it is psychological. Do you see the difference? The small account is not there to make you rich. It is there to reveal who you are when money is involved. And what does it reveal? Watch your behavior closely. Notice how badly you want action. Notice how uncomfortable waiting feels. Notice how often you convince yourself that a weak setup is good enough. Notice how quickly fear appears when price moves slightly against you, and how greed appears the moment price moves slightly in your favor. This is valuable information. Most traders study charts but ignore themselves. That is backwards. The chart shows opportunity. Your behavior determines whether opportunity becomes profit or loss. Now consider the practical side. With a $10 account, every decision must become selective. That limitation is a gift. Why? Because when resources are scarce, waste becomes obvious. You cannot afford random entries. You cannot afford emotional trades. You cannot afford oversized positions. You cannot afford to be wrong carelessly. So what should you look for? Look for clean movement, not constant movement. There is a difference. A market that moves wildly is exciting, but excitement is expensive. A market with clear structure, clear support, clear resistance, clear momentum shift. That is where thought has room to work. That is where probability becomes visible. Ask yourself, is price behaving clearly, or am I forcing a story onto noise? That question alone can save an account. Then look at timing. Many traders believe profit comes from being active. In truth, profit often comes from being inactive until conditions become obvious. Waiting is not wasted time. Waiting is analysis. Waiting is protection. Waiting is positioning. The hunter who fires at every sound goes hungry. The hunter who understands timing eats consistently. Trading is no different. And what should you avoid? Avoid the urge to recover quickly. That impulse destroys small accounts faster than bad analysis. A loss creates emotional friction. The mind wants balance restored immediately. It whispers, take another trade. Make it back. Increase size. You know what happens next, but markets punish urgency. Cause and effect. Urgency leads to forced entries. Forced entries lead to poor positioning. Poor positioning leads to losses. Losses create frustration. Frustration destroys judgment. And judgment, once damaged, creates a spiral few traders recognize until capital is gone. So instead, slow down. After loss, observe. Ask, was my idea wrong, or was my execution wrong? Those are very different problems. A right idea with poor execution teaches patience. A wrong idea with good execution teaches analysis. A wrong idea with poor execution teaches humility. Each lesson has value, if you are willing to see it. Now here is something few understand about the $10 challenge. The real edge is not compounding money, it is compounding decision quality. One disciplined trade becomes two disciplined trades. Two become 10, 10 become habit. Habit becomes instinct. Instinct becomes confidence, not loud confidence, not reckless confidence, but quiet confidence rooted in repetition and proof. Can you feel how different that is? That kind of confidence does not need excitement. It does not need prediction. It does not need validation from social media or trading communities shouting about easy gains. It needs process, and process is built through repetition under rules. Maybe you decide, only A-grade setups, only defined risk, only 1 or 2 trades per session, no trading after emotional disturbance, journal every mistake. Simple rules, but can you follow them? That is the challenge. Not growth of capital, control of self. And here is the curious part. Once you stop trying to force $10 into a fortune, your trading often improves. Why? Because pressure fades. Clear thinking returns. Selectivity increases. Emotional noise quiets. You begin seeing what the market is actually doing, instead of what you desperately want it to do. Then something changes. Your account may still be small, but your thinking is no longer small. You start reading price behavior differently. A breakout is no longer automatically strength. You ask whether participation supports it. A pullback is no longer automatically weakness. You ask whether it is simply resting before continuation. Volume, momentum, reaction, hesitation. You begin interpreting behavior instead of reacting to movement. That is when trading becomes less mechanical and more observational, less prediction, more understanding. And once understanding begins, another question appears, one most traders avoid because it forces honesty. Am I trading to express discipline, or am I trading to satisfy emotion? Everything hangs on that answer. Because if emotion is driving, the market will always find your weakness. But if discipline is driving, even a tiny account becomes training ground for something much larger. Most people misunderstand the idea of a $10 trading account. They see a small number and immediately think small opportunity. They assume the challenge is about turning something tiny into something impressive. They begin calculating returns before they have learned how to control decisions. Their eyes move to profit first, discipline second. And that is where the mistake quietly begins, because a $10 account is not really a mission. It is a mirror. It reflects everything you are as a trader. Your patience, your impulsiveness, your discipline, your fear, your greed, and most importantly, the habits you repeat without noticing. The small account simply makes those habits easier to see. When there is little money involved, excuses become louder and discipline becomes weaker. Traders take careless entries because it's only $10. They ignore risk because the loss feels small. They chase moves they should have left alone because emotionally, the account feels disposable. But behavior never stays small. That is what many fail to understand. The way you treat $10 is often the way you will treat 1,000, just with larger consequences. If you rush into weak setups now, you will rush later. If you overtrade now, you will overtrade with more capital. If you panic at small losses now, bigger money will only magnify that panic. Capital changes size, but human nature tends to remain exactly where it is unless it is trained. So what is the mirror showing you? Look closely at your decisions. Do you enter because your setup is clear, or because you are tired of waiting? Do you exit because your plan says so, or because emotion suddenly takes control? Do you size trades logically, or do you secretly gamble because you want fast results? These questions matter more than the balance itself, because the answers reveal what kind of trader is being built underneath the surface. And that hidden trader is the one who eventually controls larger money. The market has a way of exposing character. It does not do it dramatically. It does it quietly, trade by trade, decision by decision. One impulsive click reveals impatience. One revenge trade reveals emotional weakness. One oversized position reveals greed disguised as confidence. These moments seem small, but repeated often enough, they become identity. That is why the $10 account is valuable. It gives you a cheap education in self-awareness. You begin noticing patterns in your own behavior that charts will never show you. You notice how badly you crave action. You notice how uncomfortable discipline feels at first. You notice how often your mind tries to justify bad trades with clever reasoning. And once you start seeing these things clearly, trading becomes less about beating the market and more about mastering your own responses to it. Then your perspective changes. You stop asking how quickly you can grow the account and start asking whether your decisions are worthy of growth at all. You begin respecting small trades. You begin waiting longer for quality setups. You begin protecting capital instead of attacking the market blindly. The account may still be small, but your thinking starts becoming sharp, calm, and deliberate. And that is when the mirror begins showing something different. Not impatience, not recklessness, but control. Small capital creates a dangerous illusion. It makes traders believe discipline matters less. When the account is small, risk feels casual. Losses seem easy to replace. Mistakes appear harmless. Because of that, many traders become loose with their decisions. They enter trades without clear reasons. They hold losing positions longer than planned. They increase size recklessly, hoping one trade will change everything. They stop treating trading like a craft and start treating it like a shortcut. But small capital demands bigger discipline, not less. Why? Because when resources are limited, every decision carries weight. There is less room for emotional mistakes, less room for impatience, less room for careless execution. A trader with small capital cannot survive repeated errors, which means discipline stops being an advantage and becomes a necessity. It becomes protection. It becomes structure. It becomes the thin line between staying in the game and being removed from it. That changes how you must think. Instead of asking, how much can I make from this trade? Ask, how clean is this opportunity? Instead of focusing on quick growth, focus on quality decisions. A small account should force selectiveness. It should make you patient. It should teach you to wait for moments that are clear, not moments that are exciting. The market offers endless movement, but not every movement deserves your attention. Discipline is knowing the difference. Look at how most traders behave with small money. They overtrade because they think volume creates opportunity. They chase fast candles because movement creates emotional urgency. They abandon plans because waiting feels uncomfortable. In truth, these habits are signs of weakness, not ambition. The trader who cannot stay still with small capital will become even more unstable when larger money is involved. Because money magnifies behavior. If discipline is weak, size exposes it. If discipline is strong, size rewards it. That is why small capital should be treated seriously. Not because the amount is large, but because the habits formed around it become permanent if repeated long enough. Every controlled entry builds patience. Every respected stop-loss builds trust in process. Every avoided bad setup builds judgment. These things seem invisible in the beginning, but over time they create the foundation that strong traders stand on. And strong traders are rarely flashy. They are measured. They are deliberate. They understand that trading is often won in restraint, not action. They know that preserving capital is as important as growing it. They know that forcing trades out of boredom leads to poor positioning, and poor positioning leads to emotional decisions. Cause creates effect, and in trading, small careless actions often create large painful consequences. So discipline must become bigger than desire, bigger than greed, bigger than impatience. When your account is small, your focus should become narrow and sharp. Protect capital. Respect risk. Trade only what makes sense. Ignore noise. Let weak setups pass. Let emotional urges fade without acting on them. Build a routine that does not depend on excitement. Build habits that remain stable whether the account is $10 or 10,000. That is where real growth begins. Quietly, trade by trade, with discipline larger than the account itself. Most traders want reward before they understand risk. That is the root of many failures in small accounts. They look at the market and see possibility. Fast gains, quick growth, dramatic moves. Their attention goes straight to what can be earned. Very little thought is given to what can be lost, how quickly capital can disappear, or how one reckless decision can damage both money and confidence. The mind becomes fascinated by outcome while ignoring exposure. But risk comes first, whether you respect it or not. The market always collects its price. A trader who does not understand this begins building dangerous habits early. He takes oversized positions because the account feels small. He ignores stop losses because he believes price will come back. He enters weak setups because he wants action. He adds to losing trades because accepting a small loss feels harder than hoping for reversal. On the surface, these decisions seem isolated. In reality, they are building a habit of careless risk. And habits become identity. This is what many overlook. Before reward ever becomes consistent, the habit of managing risk must become natural. Not forced, not occasional, natural. It must become part of how you think, how you enter, how you size positions, and how you respond when the market proves you wrong. Without that habit, every profit becomes unstable because it sits on weak ground. What does proper risk habit look like? It begins with acceptance. Accept that loss is part of trading. Accept that being wrong is normal. Accept that protecting capital matters more than proving yourself right. Once that understanding settles in, your behavior changes. You stop seeing stop losses as punishment and start seeing them as protection. You stop forcing trades because patience becomes more valuable than random opportunity. You stop measuring success by winning trades alone and start measuring it by quality execution. That is when a trader begins maturing. Risk discipline creates mental clarity. Why? Because when your downside is controlled, fear loses much of its power. You are no longer trapped emotionally in every small move. You can think clearly. You can observe price behavior without panic. You can exit without hesitation when your idea is invalidated. This calmness improves decision-making, and improved decision-making creates better outcomes over time. Cause and effect. Controlled risk leads to emotional stability. Emotional stability leads to sharper judgment. Sharper judgment leads to stronger execution. And stronger execution creates the kind of consistency traders spend years chasing. But reverse that process and everything collapses. Poor risk creates fear. Fear creates hesitation. Hesitation creates mistakes. Mistakes create frustration. Frustration destroys discipline. Then trading becomes emotional survival instead of intelligent decision-making. This is why reward must come second. Always. Not because profit is unimportant, but because profit built without risk discipline rarely lasts. Fast gains earned through reckless behavior create false confidence. That confidence leads to bigger bets, weaker judgment, and eventually painful losses that erase both money and belief. The market teaches this lesson repeatedly. The wise trader learns it early. Build the habit of risk before you seek the reward of size. Make caution part of your routine. Let discipline shape your instincts. Then opportunity begins to look different. Tiny accounts have a way of exposing truths that larger accounts can temporarily hide. That is what makes them so revealing. When capital is small, every weakness in a trader's thinking becomes easier to spot. There is nowhere to hide behind size, luck, or temporary wins. The habits that quietly shape behavior begin showing themselves in plain view. Impatience becomes obvious. Greed becomes visible. Fear becomes easier to recognize. Recklessness no longer wears a clever disguise. A tiny account strips trading down to its rawest form and shows you exactly what kind of operator you are becoming. Most traders do not realize this at first. They blame the account size. They say the capital is too small to work with, too limited to grow, too restrictive to trade properly. But often, what they call limitation is actually exposure. The small account is not revealing a lack of opportunity, it is revealing weakness in execution. Poor entries become costly. Emotional decisions become frequent. Overtrading becomes easier to identify. The truth rises quickly because small mistakes have nowhere to hide. And weakness follows patterns. One trader cannot wait. He enters early, always afraid of missing movement. Another trader cannot accept loss. He holds bad positions, hoping the market will rescue him. Another trader chases every fast candle because movement excites him more than structure. Another trader keeps changing strategy because patience feels slower than searching for shortcuts. Different behaviors, same root problem, weakness under pressure. The market notices all of it. Not because it is personal, but because markets punish unstable behavior. Impulsive entries create poor positioning. Poor positioning creates emotional stress. Emotional stress weakens judgment. Weak judgment creates repeated mistakes. Over time, what started as a small flaw becomes a cycle of self-inflicted damage. The account shrinks, confidence fades, and frustration grows, not because the market was impossible, but because weakness was left unexamined. That is where tiny accounts become valuable. They reveal what larger money would only magnify. If impatience controls you with $10, it will control you with 1,000. If fear causes hesitation now, larger risk will deepen that hesitation later. If greed pushes you into reckless trades now, more capital will simply make greed more expensive. Weakness does not disappear when money increases. It becomes louder. That is why small accounts should be studied carefully. Watch your own behavior like you would study a chart. Notice what triggers emotional decisions. Notice what kind of setups pull you in impulsively. Notice how you react after loss. Notice whether boredom pushes you into unnecessary trades. These patterns matter because they reveal your true trading nature, the part that strategy alone cannot fix. And once weakness becomes visible, it can be addressed. Patience can be trained. Discipline can be strengthened. Emotional reactions can be understood before they become action. That is where real progress starts, not in finding perfect entries, but in recognizing the flaws that keep repeating beneath the surface. Tiny accounts expose big weaknesses, quietly, honestly, without mercy. Most traders think profit begins when they enter a trade. In reality, profit often begins long before that. It begins in the moments when nothing is happening, when price is moving, but no clear opportunity is present, when the market is active, but structure is weak, when candles are forming, but direction is uncertain. These are the moments that test a trader most, because waiting feels unproductive, and the human mind struggles with stillness. That is where patience becomes the first profit. Not money, profit in judgment, profit in clarity, profit in preservation. A trader who can wait avoids weak setups. He avoids forced entries created by boredom. He avoids chasing moves that are already extended. He avoids placing capital into uncertainty simply because he feels the need to participate. Every bad trade avoided is capital saved, emotional energy protected, and discipline strengthened. That is profit, even if no money was made. Many never understand this. They confuse activity with progress. They believe being involved means being productive. They open trades because the market is open. They react to every sharp move. They convince themselves that constant action creates more chances to win. But frequent action without quality decision making often produces the opposite. More mistakes, more emotional pressure, and more unnecessary loss. Patience breaks that cycle. Why? Because patience creates selectiveness. Selectiveness improves entries. Better entries reduce emotional stress. Reduced stress improves execution. And improved execution creates consistency. Cause and effect. The patient trader sees things others miss because he is not in a hurry. He notices whether momentum is real or fading. He watches how price reacts at important levels instead of guessing. He sees whether volume supports movement or quietly disagrees with it. He understands that clear opportunity does not need to be forced. It becomes obvious through observation. That kind of patience is skill, but patience is difficult because it fights instinct. The mind craves movement. It wants excitement. It wants immediate reward. Waiting feels like doing nothing, even when waiting is the most intelligent action available. This is why many traders enter mediocre setups. Not because they see real opportunity, but because silence makes them uncomfortable. They would rather be wrong in action than disciplined in stillness. That habit is expensive. One rushed trade creates loss. Loss creates frustration. Frustration creates urgency. Urgency creates another poor trade. And suddenly a quiet market becomes a chain of emotional mistakes. Patience stops that before it starts. It teaches restraint. It teaches observation. It teaches that not trading is often a position in itself, a position of strength, not hesitation. And over time, something changes. You stop feeling pressure to catch every move. You stop reacting to noise. You become comfortable letting weak opportunities pass. You begin trusting that the market will always create another chance, but only if your capital and judgment remain intact. That is when patience becomes more than waiting. It becomes edge, quiet, steady edge, the kind most traders rush past. Small accounts tempt traders to think small. That is the first mistake. When capital is limited, many begin acting with a short horizon. They look for quick wins, fast flips, and oversized trades that promise sudden growth. Their thinking becomes narrow, focused only on immediate reward. Every trade feels like it must matter greatly. Every opportunity feels urgent. Every missed move feels painful. They trade from scarcity, and scarcity creates emotional decisions. But a serious trader must do the opposite. Trade small, think large, act precise. Trading small is not weakness, it is control. It means risking little enough that one mistake does not damage your confidence or your account. It means giving yourself room to think clearly instead of trading under pressure. Small size keeps emotion quieter. Fear becomes manageable. Greed becomes easier to observe. Patience becomes easier to practice. You are no longer fighting survival. You are building skill. That is where real development begins. But while you trade small, your thinking must remain large. What does that mean? It means seeing beyond today's profit or loss. It means understanding that each trade is shaping habits that will define your future performance. A small gain earned with discipline is worth more than a large gain earned recklessly, because disciplined profit teaches repeatable behavior. Reckless profit teaches dangerous confidence. One builds foundation, the other builds illusion. Think large enough to value process over excitement. Think large enough to respect consistency over dramatic wins. Think large enough to understand that the goal is not to have a lucky week, but to become the kind of trader who can perform for years. That kind of thinking changes behavior. You stop chasing noise. You stop forcing opportunities. You stop treating the market like a machine that owes you money. Instead, you begin observing carefully. You wait for alignment. Clear structure, logical entry, defined risk, favorable conditions. You become selective because your focus is no longer on constant action, but on meaningful action. And that leads to the final part. Act precise. Precision is what separates disciplined traders from emotional ones. Precision means entering for a clear reason, not vague hope. It means knowing where you are wrong before entering. It means sizing correctly, executing calmly, and respecting the plan once the trade is live. No random clicks. No impulsive changes. No emotional improvisation when pressure rises. Every action becomes deliberate. Precision creates consistency because it removes chaos. Chaotic entries create uncertainty. Uncertainty creates hesitation. Hesitation creates mistakes. Mistakes create emotional reactions, and emotional reactions destroy discipline. But precision reverses the chain. Clear action creates confidence. Confidence creates calmness. Calmness improves judgment. Judgment improves execution. Execution builds trust in yourself. That trust becomes powerful. Soon, the account size matters less than the quality of your decisions. You may still be trading small, but your mindset becomes sharp, steady, and mature. You begin moving with intention instead of impulse. You stop trying to force growth and start becoming worthy of growth. That is when small trading becomes serious trading. Quietly, with precision. Most traders are obsessed with one kind of compounding, money. They calculate percentages, imagine exponential growth, and dream about what a small account could become if a few trades go their way. Their focus stays fixed on numbers. How quickly capital can multiply, how soon the account can grow, how fast trading can become meaningful financially. On the surface, that sounds logical, but underneath, it creates a dangerous blind spot. They ignore the compounding that matters first. Discipline compounds faster than money. And unlike profit, discipline does not depend on market conditions. Every time you wait for a clean setup instead of forcing a trade, discipline grows. Every time you respect your risk limit, discipline grows. Every time you close a losing trade without argument, discipline grows. Every time you resist revenge trading, avoid emotional entries, and stay loyal to process, discipline strengthens quietly beneath the surface. At first, these moments seem small, almost invisible, but repetition changes everything. One disciplined decision makes the next disciplined decision easier. Good habits begin reinforcing each other. Patience becomes more natural. Emotional reactions become weaker. Clear thinking becomes more consistent. You stop feeling pulled by every movement in the market. because your behavior is no longer controlled by impulse. It is guided by structure. That is compounding, quiet growth that builds strength over time, and the effect becomes powerful. Discipline improves timing because you stop rushing. Better timing improves entries. Better entries reduce emotional pressure. Reduced pressure improves judgment. Better judgment improves execution. Stronger execution creates confidence. Not reckless confidence, but grounded confidence built on repeated proof that you can trust your own process. Cause builds effect. Effect strengthens cause. The cycle keeps feeding itself.